Thank you for joining us this evening. My name is Arvind Chari. I am now the Chief Investment Officer at Q India UK, which is the affiliate of Quantum Advisors India. I, of course, joined Quantum in 2004, and I know some few familiar faces who have heard me before because I used to be a fund manager at Quantum Mutual Fund, managing the Quantum Liquid Fund, the Quantum, and I, along with Chirag, my colleague, started the Quantum Gold ETF and the multi-asset equity fund of funds. Since 2013, I moved to Quantum Advisors, and now as a CIO, my job is to go and talk to global investors and flag two flags. One is the flag of India, to tell them that more global investors, foreign investors need to invest in India. And in terms of what is the risk, what is the opportunity, what they should do, what they should not. And the second flag, of course, is the quantum flag, to tell them that here is a investment firm which has been since 1990. The Q India Value Equity Strategy Composite now this year has a 25th year of its track record. And we have shown over cycles, over times, how what we call sensible risk adjusted, and you will hear all these things laid out in the presentation in the next 1.5 hours, how we have managed money for global investors and how quantum should be the core allocation for every investor. And this IMC brings a lot of nostalgia. This is where I started some of my engagements with investors through what we call Path to Profit. And we started Path to Profit in 2009 as a way to connect initially to investors, because some of you who remember, Quantum Mutual Fund was the first direct to investor mutual fund. And we built the first online paperless investing platform in India. And Path to Profit was our way of going around the country, speaking to investors like you who are sitting here. And I still remember, I think it was in an IMC meet where an investor got up after Ajit had finished speaking about the philosophy, the process, about how we think about governance, how we think about valuation, how we put investor at the center of everything that we do. And he said, Ajit, can I come on to you and pinch you? Because I want to know whether you're for real. And that's the reason we also started Path to Profit. We wanted investors to pinch and feel us and then experience what we say. And then, of course, invest in the Indian growth journey through Quantum Mutual Fund. Today, I'm going to talk, before we get on, I just want to give you a context, because today is all about context. In every conversation that you hear, you will see context, content, and everything that you as an investor need for your asset allocation will get covered today here. So if you look at the current markets, you're seeing markets are correcting. And if you see one headline that is flashing around, it will be foreign investors are sellers. And that is true. Since October of last year, foreign investors have sold about $25 billion of Indian public equities. Now, there is a context to it. If I look at 20-year period, foreign investors invested about $200 billion in Indian markets at cost. And of course, buoyed by all you people here and all Indian retail investors, Indian mutual funds invested $160 billion in just the last 10 years, right? So that's the proportion of investment. Foreign investors over 20 years have done $200 billion. Indian mutual funds have already done $160 billion worth of Indian equity investing. The other context is that $200 billion of foreign money has become about $950 billion at peak. And after that $25 billion sale and the fall in market value about 15-20%, that would be about $800 billion. So this $25 billion of sale is less than 5% of what foreign investors own in India, and they have sold. So that is the context that you need to understand in terms of, it's not that they have sold a lot. Of course, markets have corrected, but there has been a big support. And this is in terms of it's not that FIIs are quitting India. They still have $800 billion worth of Indian equities in the Indian markets. And I believe that will change and will increase. And I'll tell you why. The global wealth, the global AUM that is estimated as about $300 trillion. And Indian equities has, at the best, at the peak, $1 trillion of public equity money. So it's 30 basis points, 0.3% of the global AUM is invested in India. India's weight in the global GDP is about 4%. India's weight in global stock markets is about 4.5%. In foreign investors are under allocated to India. And as that message goes on, and that's one of my jobs, and one of the things that we keep on writing and saying, foreign investors need to be more and more allocated. So you will see these gyrations of buying and selling, but in the broad sense, foreign investors will be a lot more invested in India over the next 5, 10, 15, 20 years. And so any opportunity, like our guidance itself to foreign investors and even domestic will be, if you do not have investment in India, start allocating. This is a great time to start buying and building a long-term India portfolio. With that, we have an amazing first panel. Ajit, of course, Ajit Dayal is the founder of Quantum. Subbu is kind of co-founder been with Quantum since 1996. And Derek Brodersen, whom I have known before he became the board of director at Quantum. He's the ex-CIO of Alberta Teachers Retirement Pension Fund. And I have spoken many times about this aspect, saying that why are foreign investors not allocating as much as they should be allocating in India? And you will hear from Ajit, Subbu, and Derek on why they think that and many things more. So looking forward to a great discussion. Just one information. So we'll have the panel, and then we'll have Chirag coming in talking about 12, 20, 80. And then we'll have George and Christy coming and talking about the Q India Value Equity Strategy, Quantum Long-Term Equity Value Fund. So thank you so much. Ajit, Subbu, and Derek, on to you.
Thank you, Arvind. Welcome, Derek, and welcome, everyone. There's a rumor that in the after-market hours, there's an FPI here, so the markets are going to rebound a lot and open very strong on Monday. We're going to quell that rumor by, there's long-term investors, no one's doing speculation, but
no pressure,
Derek. No pressure. How many $1 trillion? Yeah. So, when we read, as Arvind said, FPIs have put in $200 billion into India over the last few decades, we put them all in the same bucket, but they're not. FPIs are very, very different. You have university endowments, you've got foundations, you have pension funds, as we have mutual funds in India, you have mutual funds overseas. Everyone's got their own dynamic. They're not the same investor. They have different things. And we've got a treat that we have here, Derek, as Arvind introduced you, from the Alberta Teachers Pension. You want to talk us a bit about what you were doing and how pension investors actually look at liability and asset and investing? So
sure, happy to do that. And thanks for inviting me. It's a pleasure to be here. So I spent most of my career working for a Canadian pension plan for the teachers in part of Canada, in the province that I lived in. That was what's called a defined benefit pension plan. So just to start, when you talk about liabilities, Ajit, there's basically two different kinds of pension plans. What is called a defined contribution plan, and what's called a defined benefit plan. And they're quite different. A defined contribution plan is kind of like a lifetime savings account, where employees and usually employers will contribute on a regular basis. So every week, month, something comes off of your paycheck and goes into that pension plan. When you retire, whatever income that fund has earned, so basically what those assets have grown to, when your career ends and you're retiring, that's the pool of money you have to draw on to fund your pension. And you can choose how you want to do that. You can take it out in large chunks. You can spread it out over a longer period of time. A defined benefit plan, which is the kind of plan that I worked for, is one where you contribute in much the same way. But the pension you get when you retire is a lifetime pension, and it's generally a percentage of what you earn. So it might be 50% of your salary or 60 or 70. There's all different combinations. And I point that out because the two are very different when it comes to setting up an asset allocation for them. Because on the one hand, you don't really have any liabilities. You've just got a savings account that you're trying to build up to be the most you can make it by the time you retire. And so the people that are managing that plan have that in mind, and they're thinking about how to create the largest pool of capital for you when you retire without taking too much risk doing it. On the other side, on a defined benefit side, you get a whole bunch more complications. You get actuaries involved in the calculation. They start thinking about average life expectancies of the people in the plan. You have to balance off what you're paying out to people who are already retired against what you're collecting in contributions from people that aren't yet retired. So the whole process is much more complicated, but the asset allocation becomes different as a result. So for example, you always have to have money available to be able to pay out to people that are already retired. And so, for example, if you have a pension plan of a company that's not very old, you're going to have a lot more people contributing than you have already retired. So you're going to have money coming in every month that you need to invest. If you have a pension plan of a very old company that has a lot of retirees, you're probably paying out more money every month than you're bringing in. And so that has real implications for how you put an asset mix together. If you have to pay out a lot more money every month, you need to have assets that are generating income, that are generating cash flow, whether that's bonds or maybe real estate, those sorts of things. You probably have an asset mix that's more biased to those assets. If you have a much younger demographic in your pension plan, you've got more of an ability to own things that will pay off in the long run, but you don't necessarily need them to generate cash tomorrow. So you might have more things like equities in that portfolio because you don't need the cash right away.
Yes, that kind of leads to the next topic, which is like, how do you decide the asset allocation, given the fact that you have options of infrastructure, private equity, venture capital, public stock markets, timberland, and all sorts of
Right.
things that
Right.
you could buy in terms of liquidity and return and time horizons.
Pension plans will do something called an asset liability study. And what that is, without getting too technical about it, it's basically looking at the characteristics of those liabilities. So what you need to pay out over time as people retire, and compare that to the assets you have. And what you're trying to do is make sure that A, you have enough money to fund those payments that you've committed to as a pension plan. But you also want to make sure that the timing is right of those things. And so, and you want to make sure that your contribution rates aren't too high. Because as a pension plan, I mean, as an employee, you're contributing into a pension plan. And if somebody comes to you and says, you need to contribute 7% of your earnings to be in this pension plan, you might go, okay, well, that seems reasonable. That's fair. But if they came to you and said, you have to put 40% of your earnings into the pension plan, you probably say, thanks, I don't want a pension plan. I'll find some other way to save for my retirement. So you've got to think about how all those things play together. And so this idea of an asset liability study, basically what you're doing is you're making assumptions about the risk and return of all these different kinds of assets that Ajit mentioned, whether it's real estate or infrastructure, equities, bonds. And so you make an assumption about the return that you think you can earn over the next 20 or 30 years, the risk that you have in each of those asset classes, and how those asset classes act relative to each other. And that's the most important piece. Is it doesn't do any good to have 5 different kinds of assets if they all act the same way. You need assets that act different from each other to give you real diversification in your portfolio. And that's when you start to think about things like, and why you've seen things like infrastructure and real estate, timber, those sorts of things become bigger parts of pension portfolios in the last 20 years or so. It's because people are discovering that those things don't have as much in common with equities and bonds as more equities and bonds would. And so they can get better diversification in their portfolios. The other thing that they can do is hopefully generate higher returns. A lot of the private market assets, people go into them because there's an expectation that they'll deliver higher returns than public market assets will. And because a pension plan has a very long-term horizon, they can afford to invest in assets that won't pay off for a long time, that they don't have to sell anytime soon. Because in any given year, they really only need to worry about getting cash from a small part of the portfolio. So you mentioned liquidity. There's really 3 reasons why a pension plan needs liquidity. In other words, needs the ability to get cash out of their portfolio right now. First and foremost, obviously, is to be able to pay the pensions that they have to pay every month. The second reason is really just to be able to rebalance their portfolio. So if there's a change in the market and you want to sell some of this to this asset class and buy another one, some of the assets in both of those groups have to be saleable quickly in order to be able to make that change. If they were all assets that you can't sell, then you can't adjust your portfolio. And the third reason why you need liquidity is really to fund, call it ongoing financial obligations. So that might be things like if you've got currency hedges in your portfolio, or you've done something in the derivative market that requires collateral, you need liquidity, you need cash available to fund those things when they come up. So you have to kind of combine all those things when you sort of determine what's your asset mix going to look like and how much of that asset mix needs to be in things that are immediately saleable if necessary.
So the most liquid asset in the world now, approximately pensions, sovereign funds, university endowments, they control about $100 trillion of capital globally, of which India has over the last few decades got at cost or at market value now, depending on which price you take, maybe $700 billion in stocks and maybe a few $100 billion in bonds and real estate, infrastructure, etc. Over the last few decades, we've seen the US long bond decline in terms of interest rates have fallen quite sharply. And that has obviously, over the last few decades, allowed pension investors and university endowment investors, all FPIs as we know them, to look for exotic markets like India, to look for better risk return ratios, and to have outcomes that are better in dollar terms. Now that interest rates in the US for the last couple of years have been inching up, how will that influence allocations in your expectation for movement to emerging markets or any other stock?
Yeah, it's a good question. I mean, if you can earn a higher return than you could in the past on something that is seen to be less risky, like a US government bond, it makes sense that you'd think there'd be more money moving into those assets. But I'm not convinced that's the case. It might be to some extent, but the expectations for everything goes up. I mean, it's all a relative game. So if I'm looking at buying a US government bond and earning 2%, let's say, then I look at some other asset class, like let's pick infrastructure as an example, and maybe I think I can earn 6 on that. That's 4% higher than the US bond. If now US bonds will give me 4% instead of 2, I'm probably going to expect 8 from infrastructure, not still expect 6. So in a relative sense, it may not have changed all that much. If it does, if the expectation would still be 6 for infrastructure under that scenario, then you would definitely see capital transfer over time. But bond yields tend to be sort of the basis for how everything else gets priced. And so if you go to companies like actuarial firms that do long-term assumptions about all sorts of capital markets, bond yields are where they start. And they kind of drive everything else off of bond yields. So if you see bond yields go up, there might be a short-term move in other assets as a result, but the long-term expectation probably goes up for everything. And similarly, when bond yields come down, the long-term expectation for everything comes down. So Ajit, you mentioned we had a time period where interest rates were basically falling for 30 years. And that's a great environment to make money in. But the further they fell, the lower the long-term expectations become. So pension plans today have much lower expectations about their future returns than they did 25 years ago. And that's largely because interest rates are a lot lower than they were 25 years ago.
So in 1990, I wrote an article in the Wall Street Journal called Loosen the Reins on India's economy, on India's bull run. That was about 18 months before the big reform of July 1991. At that point in time, in the All Country World Index, ACWI as it's called, ACWI, India's weight, the Indian stock market weight in the global indices was 0.1%. Now it's nearing 2%. So when you look at the pension world, how closely do you monitor these indices? Are you forced to monitor them by your bosses? Like, are you sort of straitjacketed, or can you have freedom around it?
I guess the answer is a little bit of both. And what I mean by that is institutional portfolios like pension funds or university endowments. Every manager in those firms is managing to a benchmark of some kind. So they've got a target asset mix. Maybe it's 30% equities, 25% bonds, 10% real estate, et cetera. And so they'll be managing to that. And they'll vary from that to different degrees. Some funds will be very close all the time. Some funds will have much more discretion to try and go beyond that. But if you're talking specifically about equities and you get into the equity market, again, it does vary where some funds, like the fund that I worked for, we used a global equity goal or a benchmark. And how we got there, we could kind of do anything we wanted to try and get there. So we could invest in a global portfolio. We could invest in a combination of individual regions or countries, kind of anything we wanted to do, as long as the sum of the parts came close to that goal, that benchmark we were trying to meet. Other plans have structures that are much more granular. So they won't just say, we're going to put 30% into equities worldwide. They might say, we're going to put 10% into US equities and 10% into European equities and kind of go much more granular than that. The ones that do that are probably much more likely to stick really closely to those kind of predetermined weights. The ones that have a little more of a, call it a holistic approach, tend to have the flexibility to do sort of anything they want within a reasonable boundary.
So can a pension wake up on Monday morning and say, Indian markets are down 20%, they're bleeding, I just want to put a lot of money in India? Or they can't just do that overnight?
Theoretically, they could. I mean, it probably wouldn't be a huge portion of their portfolio that they'd move that quickly, but tactically, absolutely, some of them could. But
Headline for Monday.
the larger the fund, the harder it is to do that, obviously. I mean, if you have if you're one of the largest pension funds in the world, it's very difficult to move enough money in a hurry to make a difference. If you're smaller, you can absolutely do it. But the ones that are trying to be really tactical like that, doing things very quickly, they're more likely doing it in the derivative market than doing it with individual stocks, rather than going out and buying 500 Indian stocks in the first 2 hours of trading in the morning. They're probably buying Indian stock market futures if they want to do something that fast.
Derek, I have a very important question. You describe how pension funds gather assets on one hand and then you invest so that you can pay the pension over the long term. It brings to mind, it's such a huge fiduciary responsibility you have, right? You are collecting large pools of money and then you have to decide which asset class to invest. And then those asset classes have to do well. And there will obviously be some which are bad assets, I would assume. Mm-hmm. It can be a bad analytics or something going wrong, or it could be backing a bad company or bad management. So I have a question relating to that. But before that, I'll read a small poem. Right? Okay. If you don't mind.
It's in Tamil or Kannada or English?
It's in English.
Good.
It's in English. It was written after the World War II. It goes as, first they came for the Jews. That's the title. First they came for the Jews and I did not speak out because I was not a Jew. Then they came for the communists and I did not speak out because I was not a communist. Then they came for the trade unionists and I did not speak out because I was not a trade unionist. Then they came for me and there was no one left to speak out for me. Very powerful poem.
Yes.
So in the context of corporate governance, you have three choices. One is to say that I'm not invested in this company. and keep silent if something goes wrong. The other is to say, okay, I have investments, I will just sell off passively and not make a noise. And the third option is to make noise, take some action against the company. Right. So as fiduciaries, how do you approach corporate governance? Would you take action or would you just silently move away? And what should be the role of a fiduciary responsible person? We can just describe that.
Yeah, absolutely. Well, I'm personally, I'm a very big believer in good governance by companies. I was on the board of a governance related organization in Canada for many years. And we strongly advocated actively engaging with the companies that we were invested in and trying to modify their behavior and change them for the better when we didn't like something on the governance side. I think for most large institutional investors, you do see that happening. But I think you see it happening more, I think, when they feel that they can have a significant influence. So they look to be active where they think they can be successful, which more often than not is in somebody's home market. And so, I mean, we would contribute to governance engagements, if you want to call it that, with companies largely in Canada, because those Canadian companies recognized us, they knew who we were. We might have owned enough stock in their company that they would take us seriously. We didn't do a lot of it in a European company, for example, because they would have never even have heard of us. But you do it with partners. So there's a lot of collective engagement where multiple investors get together, whether it's through organizations or informally, and as a group go and engage with companies and say, we want you to improve this. We don't like this part of your governance. To me, that's the best way to do things. I mean, you can avoid buying something. I mean, if you're analyzing companies to put in your portfolio and you're very unhappy with the governance of a company, then you're probably not going to buy it in the first place. But everybody probably has companies in their portfolio that you go, okay, it's not necessarily bad enough that I'm not going to own it, but there are things that I think can improve, or they already own it and something happens. To engage with that company and try and improve things and make it better so that company is acting better in the future is, in my opinion, is certainly a much better way to go. Divestment doesn't generally accomplish much in most cases. Just selling a company because you don't like something they're doing, sometimes that's the right approach, but it doesn't necessarily change behavior very much.
We would want the fiduciaries to at least express it very clearly to change the behavior.
Absolutely. And I think I've seen many examples of companies that have changed their behavior because they were pressured to do so by enough shareholders. I've been in many meetings with the boards of directors of public companies, albeit only in Canada. But I've been in lots of meetings where we would go as part of an organization and say, we represent 35% of your shareholders. And when you can walk into a meeting of a multi-billion-dollar company and tell them you represent 35% of your shareholders, they have to listen to you and they have to take you seriously. And it's very powerful. And we've seen lots of improvement in corporate behavior as a result of that.
So now that if that's the role to be played, then how do passive investments become form of a vehicle to invest? Because on the one hand, you have no choice in the type of companies which go into these indices, and you can't really make any noise because you're buying the indices. So passive versus active. In that context, if you can explain.
Yeah. So well, from that perspective, you're right. If you're buying something passively, you're not differentiating, for one thing, between the good actors and the bad actors. So there's kind of two aspects to it. In terms of engagement with the companies, there may well be active investors in those companies that are engaging, even though you might own that company through an index fund. There could be active engaging with those companies. So it's not necessarily that people are ignoring that. But as an investor, if you make a decision that you'd like to invest in companies, or you feel it's financially the best thing to do is to invest in companies that are showing good governance, you're not doing that by investing in index funds, right? Because
I mean, I'll just sort of throw
with the bad.
I'll just sort of throw in the line here. In 1996, that's a year that Subbu joined, and we've been working together now for 29 years. We started something called the Integrity Screen. And that was to sift out companies that don't treat minority shareholders well, rather treat them very badly. And we've applied that to the Quantum Long-Term Value Fund and across the funds that we manage in Quantum. We look at that integrity score. Chirag and his team have built that from 10 indicators in 1996 to over 200 indicators today. And when you look at the popular indices in India, everyone talks about passive investing, index investing in India, that being a better way to invest. Well, guess what? Probably anywhere from 20% to a third of the indices are companies that we would not touch with a 10,000-mile bargeboard. They're terrible in terms of corporate governance. They fail our integrity screens, but they are there in the indices. So when you invest in a passive index fund, you're actually supporting companies, in our view, with poor governance. That's at least our perception. But when you come to the emerging markets in India and nations, I mean, how do pensions worry, or how do they take care of that fiduciary responsibility across borders, especially in places where doing not so good things may be relatively more common?
Yeah, it's a good question. And I think that so some investors will take an active approach, and by that I mean they will hire active managers. They won't invest in index funds necessarily in those markets. Some investors will frankly just avoid those markets and say it's too complicated. It gets too messy. I just don't want to do it, so they'll avoid them. Some will hire active managers, so they'd look at it. Quantum would be a great example of a manager that looks at this and tries to avoid those companies that are not behaving well from a governance perspective. And then there's still lots that just don't pay that much attention to it, to be honest. The ones that are index investors they've unfortunately a lot of institutions will think about their index investments a little differently than they will their active investments when it comes to things like governance. They'll take governance seriously in active portfolios, but when they make a passive investment, they kind of look at it and say, well, that's just a passive investment. I can't have any influence, and it kind of doesn't go any further. And that's unfortunate, but that's the fact of life. Yeah.
So continuing on that, first corporate governance we covered, but in general, how do pensions from developed economies look at, say, emerging markets, global emerging markets, and how do you look at specific countries, like say India? Would you take that extra step to invest in a specific country, or would you be better off only in the gems?
Right. Sure. So looking at emerging markets as a whole, I think it's changed a little bit in the last several years. And what I mean by that is if you go back 15 years ago, let's say, 10 years ago even, and you look at the global equity market returns from the 10 or 15 years leading up to that time, emerging markets did quite a bit better than developed markets. And so there was a big push among institutions to get more exposure to emerging markets. I remember us doing one of our asset liability studies probably 15 years ago and dramatically increasing the exposure we had to emerging market equities. I think that's changing in recent years. And I think it's changed because, and this isn't specific, nothing to do with India specifically, but emerging markets in general haven't really performed meaningfully better than developed markets in the last several years. And so I think a lot of investors have looked and said, well, there's a feeling that I'm taking more risk in emerging markets than I am in developed markets. And if I'm not getting paid any extra for that risk, why would I take that extra risk on? So I've seen a number of plans that have actually reduced their emerging market exposure in the last 5 years or so, but that goes in cycles. That's not a permanent change, I'm sure. That's a cyclical thing. And that will likely come back again at some point. To your question about individual countries, that's more of a challenge for developed market investors. The ones that will do single country mandates in emerging markets, so they'll buy an India only fund or a China only fund or an Indonesia only fund, they tend to be the bigger funds because they have the staff and the resources to actually do the work required to make that decision. So when you look at emerging markets as a whole, I don't know how many countries there are in the emerging index, 29 or something like that, give or take. So to make a decision to buy one particular country, you're also making a decision to buy less of all the other countries. And so it's not quite as simple as saying, I'm going to do a whole bunch of work on India and decide whether I want to put extra money in India, because you don't know whether India is the place to put your extra money unless you do a whole bunch of work on 28 other emerging markets as well. And so it's a much bigger job than just saying, I'm going to spend 6 months researching the Indian market and decide to make an allocation to that, because something else might be better. And so unless you know what the something else is, you don't actually know whether, and so the challenge is having the ability and the people power to do all that research on all those markets.
So without a personal bias from your side, because you are from Canada and we've had a change of presidency in the US, and there's talk about sovereign nations taking over other sovereign nations. So without that personal bias, there's been a big change in the world with the election of President Trump.
Sorry to interrupt you, G. Just before we go there, can I get on my soapbox for a minute about passive versus active?
Yes.
But before we go down that road, I have a personal belief that very few people share, and that's I don't believe there is no such thing as passive investing in my mind. By buying an index fund, all you're doing is you're outsourcing your stock decisions to a company that creates indexes like MSCI or somebody like that. So there's all kinds of opportunities to buy, for example, quantitative funds where people use algorithms to pick stocks, and maybe they're based on, the revenue, the earnings. There's all different things that they base them on. Well, when you buy an index fund, what you're doing is you're buying MSCI or S&P or whoever the index providers, you're buying their formula for creating a portfolio. And their formula, in most of those, their formula is the tradable market cap of a company, not the size of the market cap, but not the size of the company, but how much of their stock is freely trading in the market. That's what determines how big the weight of the stock is in the index. And so if you buy an index, you're not putting most of the money in the best companies. You're putting most of the money in the companies that happen to have the most stock trading on the market. And so to me, it's a choice of an investment style. And unfortunately, I think there's way too many investors that look at an index and say that's the lowest risk way of investing in a market. And it's absolutely not the lowest risk way of investing in the market. It's just a decision to outsource your stock choices to an index provider.
And to that point, I used to manage money for Vanguard. I ran the Vanguard International Value Fund when living in the US for about 4.5 years. So when I came back to India and when we started Quantum AMC, we were launching an index fund here. So I sent an email to John Bogle, who was the founder of Vanguard and the father of index fund investing, explaining how the index is constructed in India. And there's a quote I put up on the internet. There's a quote from him which says that index investing in India sounds just plain foolish. And nothing has changed in the way they construct indices. Mr. Bogle is no longer alive, but that thought of his, I'm sure, still carries on. But let's go back to what I was getting to, Trump, the big trade in the world. So if you were CIO, what would you be doing? How would you react to what's going on in the world, and what are the challenges you would face if you were running pension money? And on behalf of individual investors, how do you think they should start to view the world and allocations?
Yeah, well, I think the first thing you have to do is examine how much risk you have in your portfolio and where that risk is. Because the challenge with what's happened in the last month or so in the US with Trump, whether you like him or don't like him is kind of irrelevant. The reality is it's become unpredictable. He's very unpredictable. And what the US is going to do on the policy front, whether it's tariffs or anything else, has become very unpredictable. That just raises the amount of risk in the market. And so I think in running a portfolio, you have to look at where the risks are in your portfolio and think about where you might want to reduce that risk for the time being until things become clearer. So, for example, if you've got companies in your portfolio that are highly dependent on exporting to the US and having significant tariffs placed on those products by the US would have a dramatic impact on the company's revenue, you probably need to think pretty hard about what the short-term future of that company is going to look like. No guarantee it's going to happen. Trump's made lots of comments and promises that haven't panned out, but he's also done things that people haven't expected. And so you have to believe that some of that is going to happen, and you have to think about what impact that's going to have on your portfolio.
So there's a sense in India that Prime Minister Modi and President Trump hit off very well. And, we're like 10,000 miles away. You guys are close by neighbors. Should we be relying upon friendships? President Trump?
Well, I mean, we're not making any overt political statements here. I mean, President Trump is certainly seems to treat his friends better than people that aren't his friends. For some reason, being a Canadian, our prime minister doesn't seem to be his friend, and he's very much picking on Canada these days. I don't quite understand what it is about Canada other than we're directly next door, we're a much smaller economy, and we have a lot of natural resources that he would probably like to have. And he probably is, in my view, he's picking on Canada because he can. We're seen to be like the little, not geographically little, but population-wise and economy-wise, the little neighbor that he can pick on, and we can't really do anything to push back. India is a little farther away and not nearly as connected to the US economy as Canada is. The US and Canadian economies are very intertwined. And so it's harder for him to have that kind of an impact on those other countries. So any threats he makes or any radical things he does on the trade front are certainly going to impact Canada and Mexico more than pretty much any other country, just because those three economies in North America are so intertwined with each other.
So I think last question before we've already run out of time, but I do want to ask, we did, if you look at the US dollar, the reserve currency of the world for decades, what do you think is the outlook going forward on dollar as a currency, as a reserve currency, and hence the financial system in the world? The big question.
My honest answer, I have absolutely no idea.
What's your guess?
My guess is that that's not changing anytime soon.
Should not worry about dumping US dollars and buying Bitcoin.
I don't think so. Well, if you're going to dump US dollars, I could suggest a few things other than Bitcoin to buy. But
a lot of people are buying Bitcoin these days, apparently.
But I can't see that status of the US currency as the world's reserve currency changing anytime soon.
Thanks. Thank you. Thank you. Thanks.
Thanks for having me.
Yeah, good evening, everyone. Before we have the presentation on, just to ask you, how many are worried about the markets today? What's happening with the markets? Yes. Probably you need to have more quantum funds in your portfolio. That will help you for sure. And also the formula that we have been talking about for a long time, asset allocation, right? It gets to as simple as having a good asset in place. That will not have you worried. So we'll talk about that and the journey that we have seen many investors go through for a very long time. So started in 2006, and we will see a investor's journey in terms of what asset classes have done since that time frame. and the behavior that usually investors end up having when they participate in the markets. So if you see, we have, writing was there on the wall, right? Markets corrected because valuations were high. It was clearly there. And the valuations correction is healthy, was needed, was warranted in the markets. And that is what we have seen currently. So if you see times when, mid caps have done well, times when small caps have done well, times when large caps have done well, and times when things like bonds and gold have done well, So it's very difficult to pinpoint and say, and imagine someone holding an all equity portfolio in 2008 or be it 2024, and the destruction that they would have seen in value at that point in time versus holding non-equity in 2009 when the rally came. Like many get fearful and panic and get out of equities right at the wrong time. And that is a thought that many investors have today in terms of, should I be in equities at all? Because many investors who came into the market post-COVID have not seen what we are witnessing today. The kind of fall that we're seeing today, we have seen such falls in the past. Yeah, so let's start a journey, right? Let's see how markets have panned since 2006, coinciding well with when quantum started, our first funds were launched. And if you see, post the rally of 2003, 4, 5, 6, 7, equities were the asset class that everyone was getting into. And right at the end of the bull run, just generally that we see, small caps have topped the charts. Small cap, mid cap, and the top, and something like gold and bonds, though gold gives 16% return, which is a very respectable return in any time frame, was at the bottom. So many shrugged bonds and gold and went chasing equities at that point in time after equities rallied for 3-4 years in time. Yeah. And in 2008, global financial crisis hit us. Markets fell significantly. All those small cap, mid caps were heavy losers in that market. And imagine what did really well? Gold and bonds, which was written off in the previous year, were topping the charts 1 year later. Come 2009, everyone was fearing equities, and the rally that happened, all equities were topping the chart again. And that is the time, again, people will start chasing equities and forget the bond and gold. Gold still gave 24% return in that year, but having still done better, people will move into equities at that point in time. 2010, again, equities flattish after a good run up in terms of catch up because 2008, actually what happened was the value of equities were at a certain level, only the price had fallen, and the price caught up with value back again, right? Because global financial crisis had nothing to do with what India had in terms of our relation with US. Crisis in the US, India had nothing to do because we were not exporting anything to the US at that point in time, right? If you were, we did a study and we saw in terms of what kind of goods that people in the US would have from India, and that made just about less than 1% of all the goods that they had in their homes, right? We had nothing to do with that crisis, and still our market tanked. But value was holding up, price had fallen because FIs were exiting, and it caught up the next year when things came to semblance. So 2011, again, gold topping the charts, equities falling. After the run-up, because the run-up was much more, because whenever the markets swing, they swing on both sides to the extreme. Like what we are seeing in last year when markets were moving higher, from a valuation standpoint, it just swung on the other side. These are the growth rates. That is the yearly performance. And this is what, if you had started in 2006, what would be the value of that asset be post that time frame? So from 2006 to 2012, gold was the best performing asset class out there, written off when the markets were in full swing in 2003 to 2007 timeframe. Despite having positive returns from 2003 onwards, still people were not looking at gold as an asset class. So if you were to look at 26 to 2014, again, markets were catching up again, and gold started plateauing at that point in time and declining from that point. Come 2015, again, if you see that year, bonds and small cap, if you'd started your journey in 2006 till 2015, small caps gave a return that bonds did. It was equivalent to bond return, and no one was looking at bond, but everyone wanted to chase small caps in their good years. So if you look at 2017 again, the market was moving up without any earnings, and equity markets were frothier at that point in time and moving higher, similar to situation what we saw in 23, 24, right? 23 still there were earnings backing equity markets, but 24 again, it started moving beyond what earnings were supporting, right? Similar situation that we saw in 2017. And what followed after that was a fall in market. So market started falling because there was no earnings growth, similar to what we saw currently, because as our economy slowed down in 2023, earnings were not coming through, and the writing was on the wall that markets should correct because markets had rallied much more than what fundamentals would support. So come 2019 again, there were things in terms of uncertainty. Gold started moving up again, and equity markets after the fall were stabilizing. 2020, COVID happened. You can't see the fall, but there was a significant fall in markets here, but it ended the year positive when it came through. And look at where, if you started your journey 2006, if you were in small caps, look at where small caps are, very close to where the bond market returns have been, right? In some years, it may look at the most exciting market, but when you look at over a journey, it's not that attractive. So 2022, again, equity markets continue to rally post the COVID recovery, and there was earnings growth in the economy, and there is where equity markets rallied. And come 2023, they continue to rally and become frothy at that point in time. So if you see here, equity markets, where they are, especially the mid and small cap, they have rallied much more than any other asset class. And because of the liquidity chasing those markets. And come 2025, we have seen a big fall. And, large caps, no one was looking at large caps at that point in time. And look at where mid and small caps are, very close to where the large caps have been. So what does this tell you? This tells you that you need to be across the space. Each and every asset in the portfolio has a role to play, and you need to have allocation to each and every asset in your portfolio. So equities are for long term, but you need to decide your allocation, how much to large cap, how much to mid caps, and how much to small cap. According to us, small caps should not be more than 10 to 15% of your allocation. Large caps should be, and most liquid space of the market. That is where we have designed the funds for you, like the value fund, for example, which my colleagues will speak in detail. That has to be the core of your allocation because it is more tilted towards large caps. It's very liquid and has a valuation bent to it. And there are studies that have shown that, rather than chasing asset class, 90% of the variability of returns between portfolios is determined by asset allocation. So this is paramount. If you forget this and keep chasing assets, it's doomed in some sense. And the only certainty is that there will be uncertainty with your portfolios, and you don't know what uncertainty will come through. Of course, there are some black swans and some black crows here, which can be predicted, but things will come and hit your portfolio time and again. And the essence of asset allocation is protect downsides. If you were in 2020 in the COVID fall, if you were in a 100% equity portfolio, on a monthly closing basis, you would have fallen by 28%. In the depths of market, it fell to 40%, but on a closing basis in March 2020, it fell by 28% for that quarter. And if you had a 40-40-20 kind of allocation, which is diversified, you would have fallen only 8%. that tells you that it does protect downsides when you are allocated well. And over the long term also, you don't sacrifice a lot of returns. Equities from 2004 till 2025 have given roughly 12.5% returns. And if you were in a diversified basket, you would have 11% return. But look at the drawdown. An equity portfolio fell by 56% during the global financial crisis. And if you had a diversified portfolio, it just fell by 21%. 21% is more palatable for investors from a decline perspective. 56% scares people. What is better is the choice that you need to make. So people keep debating about various things which they cannot control, right? What is going to be the macroeconomic development? What is Trump going to do? No one has a clue in terms of what's going to happen. Asset allocation is if you're allocated well, and there are two ways to do it. One is to have a ready one-stop solution that mutual funds offer, like a multi-asset fund, or do it yourself. And people keep coming to us saying that, we want to create a portfolio, but we don't know how to do it. What is the magic formula that will help us create a weather-proof portfolio? And the answer to that, which we think is a time-tested formula, and we have seen it work in various market conditions, is a 12-20-80 formula. This has worked really well. And if you see, it's very, very simple to create. You can customize it. It means that 12 months of expenses, your monthly expenses, kept very, very safe. Whatever place you think is safe, if you think bank FD is safe, if you think liquid funds are safe, keep it there. We would suggest the liquid fund. And if you think that, under your mattress is better, it's safer there, you keep it there. But anywhere you think it's safe, you keep that 12 months. If you think it's lesser, and if you think there is volatility in your cash flows, you can increase it to 24, 36 months even. So it depends on what you're comfortable with. Any money that is left after that, divided 80% into equities, 20% into gold. People don't really invest in gold or not been advised to invest in gold generally. And there are certain biases towards that advice. But gold has helped most portfolios from the downfalls that we have seen in equity markets. Time and again, whenever equity markets have not done well, gold as an asset class has done well, right? So it is very inversely correlated, and you need to have an allocation to gold there. So this is, within the equity basket, again, you do not take style risk in a significant manner. If you take a particular style risk, because styles go through its own volatility, own cycles, and hence any particular style you are exposed to in a significant manner does not bode well for you. So you need to have a diversified basket across market cap spectrum, across different styles to be able to build a good portfolio. So suggested is 12% small cap, 44% equity fund of funds, because it gives you one fund, gives you exposure to different styles. 12% to ESG fund and 12% to long-term equity value fund is what we would suggest, that you build a diversified across asset classes and across styles of investing. So as I said, each thing has a role to play. One is an emergency block, one is a diversification block, and one is the growth block that will help you achieve wealth over the long term. If you see the green triangle at the top, we call it as play money. Generally, we have seen that, when it comes to allocation of investors' portfolio, this play money or this triangle becomes inverted. The play money becomes the base of one's allocation. It becomes so large that people end up having a very bad portfolio and therefore a very bad outcome. Play money has to be very, very small if at all you want to have an allocation to something that you would like. So Quantum precisely has launched funds that will help you complete your allocation across different spectrum of returns and risk, right? If you think that equity is not something that you want to get into, but you want a return better than the fixed deposits will give you, then multi-asset is a place to be. or else you create the portfolio based on, different aspects of risk and return, like we showed you in 12, 20, 80. So from a return standpoint, if you look at the returns that a 12, 20, 80 strategy delivers is comparable to what equities will give you. And if you look at the standard deviation or the drawdowns are much lesser than what you will see with equities generally. So overall, the 12, 20, 80 strategy is something that works well for you from a return perspective, from a risk perspective, and also works well. So if you look at the second line from the top is what a 12, 20, 80 strategy would deliver over the long run as compared to other asset classes out there. So if you look at the best performing asset class is mid caps that have done well since 2006. 12, 20, 80 strategy is very similar to what mid caps or the best performing asset class has delivered out there. So from a return perspective, there is nothing short that this strategy delivers. And I think if you want to create a portfolio and don't look at it for a long term and just be with it, I think it's very, very simple to create and it works really well. So with that, I will end my presentation and I'll welcome my colleagues, George on the stage to take you through how we manage portfolios for you.
So as Chirag explained, asset allocation is a key thing. And within asset allocation, I would discuss about the equity part. And within the equity block, where we believe in the 12, 20, 80 breakup, the 80% of your assets can be allocated depending on the risk appetite. We would talk about the quantum long-term equity value fund, which has built in a lot of risk management practices into its while we designed, and how that is ideal for a foundation from an equity block. See, from a quantum QLTV for the quantum long-term equity value fund perspective, the basic objective what we are trying to achieve from the fund is to buy any stock at a discount to its intrinsic value or fair value. For instance, if we compute the fair value of a stock at rupees 100 2 years down the line, if you are able to buy that stock at rupees 75 or lower, that is when it would make into the portfolio. And when we buy at 75 rupees, so what we are essentially doing is on a 2-year basis, we make a gain of about 33%. And on an annualized basis, it's about 15.5%, and which should, over long periods of time, should be better than what the index can possibly deliver. So we launched QLTVF in the year March 2006, right from April 2008. So we started plotting what could be the potential NAV of the fund on a 2-year forward basis. How we derive that is like we, in that example where we saw the stock moves from 75 to 100, where there is a 33% upside. When we multiply those upside of every individual stock with its weight and add all those numbers, we get what could be the potential NAV of the entire portfolio on a 2-year forward basis. And this orange line is based on what we expected in terms of what could be the 2-year forward number from a potential NAV basis. And this blue line is how the actual net NAV worked out, which is net of all the expenses and fees, which may not be the case for a passive fund. When you're looking at an index fund, you have to be careful that the index fund does not have an expense ratio. There is no transaction charges. So whatever you are seeing as an index return is more of a theoretical return. From a passive perspective, you would potentially earn a return lower than the index. Here is a methodology which is designed to give you a return slightly better than the index, or there is a chance to earn a return more than the index net of all the fees. And when you superimpose both the graphs, you can see it is a very close fit on long term, which means the process which we are trying to do has worked phenomenally well over the long periods of time. And of course, there are two dislocations which you would see. In October 2006, if you had asked us what could be the potential return by October 2008, in an ideal world, we would have told you it's about 32%, but the actual return came up at negative 30%. So that happened during global financial crisis. Similarly, in COVID time, in March 18, if you had asked us what could be the return, we would have given you a positive number and the actual number turned out to be negative. But the beauty there is, even in such periods, over long term, on a 2-year basis, the number has managed to get back to those predicted lines, which means that over a longer periods of time, the process have worked fairly well.
Yeah, so even as that gets started, so today is a very interesting day. If you were to look at it, the market tanked about 2%. BSE Sensex 1.9%. You look at small cap index, the fall was close to about 3%. And it is pretty interesting to talk about market positioning as of now. Since the peak which the Sensex hit last year, the correction is to the extent of 12% as of February 14. And as of today, it is to the extent of 15%. So significant correction that has happened, one of the highest probably post-COVID. And when you move to the broader indices, if you were to look at the subset of almost 4,000 companies, what we see is almost 68% of them has fallen to the extent of 30%. So that's a significant wealth erosion that has happened, over this probably short span of time. And the picture is even worse as you go down the market indices. So, for example, the 250 first to 500 stocks, which is possibly the small cap universe, as SEBI defines it, fell about 36%, which is much higher than what we see in the other indices. Going ahead, so what has led to it? The primary thing that we keep hearing is the FII flows. Close to about $21 billion outflows since October. But there is another color to it, which I'll come to if you move to the next slide. Yeah. So here is possibly, the FII and the domestic flows, how they have evolved. So if you see, since Prime Minister Modi came in, there is close to about $173 billion of inflows that we have received. Investors who have come to the market, you would possibly have not seen a significant, redemption or outflows. But that was not the case. If you look at the years following global financial crisis, for the next 5 years, there have been a redemption cycle, which saw around $4 billion of outflows from the domestic market. Moving ahead. And that is the cause of concern to us, because when we look at when we are at the current juncture, and we see the flows that have come in the past 2 years or odd, what we see is there is significant money has come into the small cap pocket as opposed to the large cap. And what we hear is, and the stats to prove that about 50% of the net unit holders into the mutual fund industry has come after COVID, around 50%. And usually these are small chunks of money, and they have come in, and we doubt really whether they would have followed any asset allocation plan, as we define it in 12-20-80 or any other asset allocation plan. So when they see this, mutual fund statement end of the every month, possibly they'll be looking at some sort of negative number, and we really don't know how they would react if this cycle continues. Moving ahead. And also to put in context, that mid-cap index or the small cap index still is at a significantly elevated valuation when compared to the narrow index or the large cap index. We also want to point out that there's a very interesting chart that the market share of large cap, we take it BSE 500 as a universe to define it, is possibly at the lowest in terms of its total share compared to the PAT share. So your market cap is the lowest within the large cap bucket, while your PAT share is the highest. And that's completely reverse for the small cap universe or the mid cap universe. So in effect, going ahead, how do we see the markets now? So one point into market, we still think the market is a bit expensive. And, even outside of if you have come to us, let's say about 6 months back or 8 months back, we have been always warning that we don't see much upsides in the market. And that's primarily driven by the fact that when we looked at our portfolio upside potential, and we have communicated to many of you that it did not look so optimistic. Hence, we were not so hopeful of the market. But now, at this point, there is some correction that has already come in. So we are getting more interested in the market. not so with the mid cap or the small cap, but essentially in the large cap. So what makes us more positive when we are looking at a slightly longer term horizon? One is key the earnings print, that the earnings trajectory that has come in the past few years, especially post-COVID. There was a period from 2014 to 19 almost where there was a period of absolutely no earnings growth. But the PEs kept expanding in that period. The market kept doing well, but the earnings growth were absolutely not there. At the current juncture, we are in an environment where the earnings growth is still good. So if you move to the next slide, what we see is this is probably similar to what we have seen in 2003 to 7, where the earnings growth is still coming through, although there is some bit of correction that is happening at one point. So this makes us more hopeful that the earnings trajectory would still be good, even going ahead. So this is another representation of earnings have evolved over a period of time. And what we see is that 14 to 16, the earnings is almost flat, right? Which is not the case now. So there is a beautiful correlation that works in Indian markets. We have about 6.5% of GDP growth every year, real GDP growth, plus inflation, it's about 11.5%. And when the country grows at that rate, it is reflected in the company's revenue also. And you see that revenue growth translating into EPS growth. And what we have seen for a very long period of time, that earning growth has broadly led the stocks, to where it is. So there is a wonderful correlation that is clearly been there between Sensex earnings growth and how the Sensex have kind of moved. And we do not think that is going to break anytime soon. And we still think that the earnings print, 2 year out looks pretty good for that growth to sustain. And so as an investor, it is very simple for us, for you to really catch on to this compounding cycle of growth. You have to have a long-term orientation. You may have your preference in terms of which, your style, whether you want value growth or who you allocate your money to, but we are sort of very clear in what we stand. The key tenet for us is, of course, having perfect corporate governance. So that's why you see absolutely zero weight in real estate companies, in energy, to those sectors where we deem corporate governance to be complete failure. We would be very valuation cognizant. Hence, you see for a very long period of time that we have absolutely no allocation to consumer staples. It's somewhere around 0%. We love those companies, but it has to come to a valuation for us to be able to enter. So right now we are positioned more towards financials where we think there is value, and some of the other sectors, cash forms around 14%. Thank you for your patient listening.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.